Past picks now with David Burrows, President and Chief Investment Strategist at Barometer Capital Management. September 18th of last year, you recommended AltaGas, ALA, trading just below 33. It's up by 11%. You're still in this one of those infrastructure players.
Of the infrastructure companies, there's probably 3 or 4 that we prefer to AltaGas, although we continue to own it. AltaGas is the most utility-like of the bunch, with a lot of recurring revenue. But they have some very attractive growth assets as well. So this is one that they'll continue to grow the dividend. And like so many of the energy infrastructure companies, found a floor over the last month while bonds continued to sell off. And I think that there's a good chance that has a pretty good fall.
There's no danger that, or not danger, but are you thinking of moving it out, or you're content with it for now?
No, actually, we've been looking for opportunities through September to add to our energy infrastructure holdings. They are starting to outperform the interest-sensitive groups, and you're going to get great dividend growth. If you think about it, the energy infrastructure group as a whole yields, say, 4.5% to 5%, and they're going to have dividend growth of 4 to 5 times GDP growth. So you compare that against any kind of fixed income instrument, that's pretty attractive. So yeah, we like the group.
You recommended Sandstorm Gold last year around this time. It's down 50% since then. You're out of it, but you actually profited here.
This was a great trade. Now you have to remember, when you're buying a gold company, they do trade around. In September of last year, I can't remember, it was probably around $7 or $8, and traded to almost $14. We got stopped out at 12 on the way down. As the gold sold off, and thankfully stayed away from the golds all the way through the winter last year. We've only recently just put a very small position on in portfolios, 2 to 3%, because the group has become pretty sold out.
In which names?
Well, we went back to the royalty companies, because again, they held up best through the decline. They're the ones that turned up early and have started to firm up. Our tendency is when a group gets very sold out. So if let's say there were 100 gold companies, and there's more than that, only 6% of them held up in price versus the rest of them selling off. When you get down to the point where almost nothing is working, and then you see the percentage of stocks doing well start to expand, it means money's getting put to work. So we made some purchases about 6 weeks ago, Franco-Nevada and Silver Wheaton.
All right.
They're small positions. If they start to work, we'll look at adding to them.
You also recommended an ETF that holds a basket of Mexican shares, EWW. This one's kind of flat. You're out of it. What was the thinking here? Well,
again, if you go back and look at many of the emerging markets or lesser developed markets had a very, very good fall in early winter this year. And again, you had to come out of them in January, February. But again, we had a good move in Mexico. And I think that you want to be a little careful of emerging markets now, South America and Asia, because I think that they're highly correlated to commodity prices, and the commodity prices, I think, generally look like they could continue to be weak for a while.
This one ran from 61 up to over 75. Did you get stopped out, or you just sold it?
We get stopped out of everything eventually.
Yeah.
But as stuff really outside of Canada, domestic Canada, U.S. started to sell off, we came out of a lot of that international exposure.
All right, those are the past picks of David Burrows. We'll come right back and get back to the questions on North American Large Cap. Stay tuned.